video, we talk timing the market. Spoiler, you can't do it. I go over my strategy in this market and how I'm moving forward. We're going to talk Tesla, Apple, Google, and Amazon, so hang tight. I've talked about this before, but just because the price is cheaper doesn't mean the stock is cheaper. Hear me out. Clearly, the prices are lower, you can accumulate shares quicker. This, of course, is assuming that you have the cash to continue investing during this recession. Knock on wood, I hope that's the case if you're watching this video. The problem is we don't know the earnings side of the equation. We know the P is low, that's for sure. But if the E has gone even lower, then the stock isn't actually cheaper, it's more expensive relatively. Ultimately, this may not matter if you believe the earnings will return, which they will eventually for most, hopefully, but not all companies. All right, so you really can't determine if these stocks are actually cheaper on an earnings basis, meaning how much are you actually paying for $1 worth of earnings? My point is the fundamental analysis can be thrown out the window to a point for the time being. Nothing is trading on fundamentals, mainly because we just don't know what those fundamentals are. Everyone is just guessing, which is part of the chaos you see in the market. We don't know how to assign value. We don't know how long this will last. We don't know what influence this will have on how the economy runs in the future. Will we be less consumer based? Will we not congregate as much? Will we live in virtual remote worlds? Companies report earnings once a quarter. That's every 3 months. And they also provide updated outlook or guidance for investors going forward. Maybe we're going to need a quarter or two to make sense of all this. Then maybe things calm down and trade on some basis in reality. Don't hold your breath. The most important takeaway from this video, if you're going to take anything away from this video, is this. Just because you think it gets worse from here, more people testing positive, more deaths, more panic, more isolation, the economy coming to a screeching halt, and massive layoffs worldwide. Just because you think that, and hey, I'm with you on that thought process, doesn't mean the market hasn't already figured that out. We have no idea what the market is pricing in. Tomorrow we can have a total and complete shutdown of planet Earth, and the market could actually respond positively to that. We just don't know, because you just can't time these things. Here at the Lemonade Stand, we're not sitting and waiting. I'm taking every dollar I don't need to live on in the next few years and buying companies. Everyone has different levels of financial security, and you have to determine what percentage of your income is safe to invest. I really need to do a thorough video on this actually with clear detail. But I'm investing every cent that I know I won't need in the coming months or years. If the market goes down further, that's fine. I'm accumulating shares faster. Market goes up, that's fine too. I can stop pulling my hair and kick back and relax. The point is, you're not going to win by sitting on cash and waiting for more bad news to come out so you can dump your cash at the bottom of this market. You're not a genius epidemiologist with stock market precognition. You're far more likely to miss your opportunity. And this part should go without say. Do not sell. If you have some real shit in your portfolio, you can rebalance into something that smells better. I've done plenty of this, tightening up my portfolio, but don't sell with the goal of waiting for a better price. Keep your shares and just continue to lower your cost basis. My strategy at the beginning of this was lowering my cost basis in the companies that have been hit most acutely. I don't know if that's going to end up being a good strategy or not. I did de-risk somewhat, selling the lower quality mall REITs I had. I've since divided my strategy between buying the total stock market, which is the absolute safest thing to do, by the way. The stock market isn't going to zero, and if it does, then we have much bigger issues, and all the money you made from your perfect market timing won't fix that. I've also been buying the companies that I feel are in the best situations to take advantage of this debacle. And I don't mean direct advantage like insert pharma company. I mean companies that have a track record of innovation, particularly during crisis. Crises? Is the plural for crisis? Crisis? I don't know. I'm looking for companies that can still make money in the current environment. Companies with amazing balance sheets. Companies that will be business as usual once all this is said and done. Because that might not be the case for some of the other companies I've talked about on this channel previously. The cruises, the airlines, the mall REITs. There's going to be ongoing issues, maybe systemically with them in the long run. That remains to be seen. I don't know. I'm still investing in those companies somewhat. I think those companies deserve a slot in your portfolio, especially if you're an investor with a long time horizon. If you have time on your side, you can take some risk. But what I'm looking at now is adding to my core positions: Google, Amazon, Apple, in that order. Apple isn't really a core position yet. It's sort of like B tier, B level, looking for an upgrade. I'll talk about these stocks in a second, but first, my wild card, Tesla. The problem for me is that Tesla makes up a significant portion of my portfolio already. I hate the feeling of having a massive overweight position. So for me to sleep better at night, it's not a buy till it's well under 300. But I think there's going to be a lot of support at the 350 to 380 levels, so I'm not sure we ever get there. You can find really good bull cases on Tesla from other YouTubers. What I will say is the COVID correction is going to impact their earnings, but they have plenty of cash to burn while times are tough. And I actually think they are in a really great position to increase market share during this turmoil. My original bull thesis didn't have them increasing market share, but I think in the current environment they can actually pull that off. But that's a topic that deserves its own video. Now for Apple. Apple has amazing balance sheets and it's not going anywhere either. Their earnings will be impacted for sure, but life should return to normal. Hopefully. The problem with Apple is that they still look expensive. Taking time off the chart, they still look expensive relative to earnings for this period, relative to themselves. Here where you see the spike, the bull thesis at the time was that the company was in the process of being re-rated as a service company.
What about services? I mean, investors are starting to buy into this. I might pay a higher multiple given the recurring revenue theme here because it's getting larger and larger as a percentage of the overall. How big can it get?
It's 14% of revenue today. It's probably going to grow at 20% for the next few years, which gets it to about 20% of revenue in the next 3 years. If investors can step back and think of services as a standalone business and give it a SaaS multiple, which it operates like, that business alone could be worth almost $400 billion. And so hard to really wrap your head around those kind of numbers, but that's how big it can get.
Instead of a hardware company, investors are willing to pay more for the former. It's so short-lived, we don't know if this re-rating was a real actual thing or if investors were just getting over-exuberant over a new unproven narrative. It's worth pointing out that they had massive earnings growth through the Great Recession. Thank you, iPhone. Jeez, look how cute this thing is. Kind of chubby. This time, the shiny new product is a streaming service.
Apple TV Plus.
Which is actually great considering people are stuck at home with nothing to do. But I'm not sold it's the product everyone has to have. Not like the iPhone was. I don't know what to think about it. So like Tesla, it's really just on my watch list. I'm just hoping it goes down much further so I can actually be a buyer again. Amazon is super well positioned for the COVID correction. I'm gonna try this movie trailer voice. In a world overrun by social distancing, you have, oh God, I can't do that. Amazon has a streaming service. They do movies and books, of course, delivery for anything you could want, anything. Grocery stores without cashiers and baggers.
Use the Amazon Go app to enter. Then put away your phone and start shopping. It's really that simple. Take whatever you like. Anything you pick up is automatically added to your virtual cart. If you change your mind about that cupcake, just put it back. Our technology will update your virtual cart automatically. So, how does it work? We used computer vision, deep learning algorithms, and sensor fusion, much like you'd find in self-driving cars. We call it Just Walk Out technology. Once you've got everything you want, you can just go. When you leave, our Just Walk Out technology adds up your virtual cart and charges your Amazon account. Your receipt is sent straight to the app, and you can keep going. Amazon Go. No lines, no checkout. No, seriously.
This, by the way, is a technology they can license to every retailer around the world, providing a better customer experience while also lowering cost. And it makes total sense in a post-COVID world. AWS is going to continue to be a juggernaut no matter what. Don't worry about regulators here. This will be the first thing to get spun off for sure, but I think investors will be better for it in the long run. Google. Okay, now we're talking. Let's move back to the charts. This is Fast Graphs, a fundamental analysis software tool. We're looking at Google here. The green shaded area is their earnings growth. You can see that during the Great Recession, the earnings grew 47% in 2008, 19% in 2009. The average earnings per share growth rate during this entire period you see here is 36% per year. That's insane. That didn't stop the stock price falling nearly 60% during the Great Recession. Gotta love those wedge deals. Earnings going up while share price falling is a deal in the making. The COVID correction has resulted in a 25% drawdown in the share price so far as of this recording. Many businesses that rely on Google for advertising are going to be in trouble, and it doesn't make sense for them to spend any capex on ads if you're not even open. I think there's going to be like a gravitational pull on earnings, but negative earnings growth just seems unlikely. Earnings did great in 2008. But growth has slowed down. You can see going into the Great Recession, the stock was considerably overvalued relative to itself, trading well above the green shaded area here. Chopping time off, we see that the growth rate has slowed down considerably, 14% annually, and the normalized PE, that blue line you see, is at a 23 multiple instead of 31 for the prior period. I don't think COVID lowers this growth rate further. I think Google is pretty well insulated and has plenty of projects in the pipeline for future growth. We have a AA+ credit rating, very low long-term debt, and plenty of cash on the books for acquisitions, other capex. The rainy day fund is on point. Share buybacks. Really need to do a video on these. It's been in the news a lot lately. But the point is, Google is not going anywhere. Save for a couple years, analysts have actually been pretty accurate at predicting the earnings. Considering the forecast here, if you took the lowest average PE for a particular period of time, it would be the average PE for the 9-year chart. So we're being conservative here. The future returns look promising at 18 to 21%. A return to long-term historic PE around 31 would result in serious wealth creation. We're talking 40 to 80% annualized returns. Now, just for fun, if we overcorrected to what I'd call overvalued territory, 80 to 200% annualized returns are possible. Though I would not bank on this at all, like seriously don't. But it isn't completely outrageous. Google has traded at much higher premiums than a 47 PE in the past. So just throwing that out there. One final note before I sign off. The EV to EBITDA at the end of 2019 was 17. Lower is better. We want a lower number here. We don't have the data to calculate the current EV to EBITDA, but we do know that the EV part of the equation has gone down since then. We can estimate roughly 20%, give or take. We also know that the EBITDA went up 34% and 16% in 08 and 09 respectively. So it's reasonable to believe we're looking at a sub 12 EV to EBITDA ratio. So on a value perspective, that puts us likely like in between the 08 and the 2012 levels on a value basis. In both cases, had you bought then, you would have earned 16 to 18% compounding returns, and that factors in the COVID correction. No COVID, and you're looking at like 22% gains annually. This wasn't meant to be a Google video, so I'm not breaking down all the ways in which Google makes its money, but suffice it to say, it's the company I feel best about buying every step of the way down. It goes lower, expect me to gobble up more. It's going to keep gobbling it. If you've made it this far and you want to invest in something like Google or Amazon, but buying a stock that costs $1,000 to $2,000 just sounds completely absurd to you, no sweat, because I have an answer for you. Don't get hung up on the share price. Got $100, got $10, doesn't matter. Check out M1 Finance. You can buy a fraction of a share. Again, don't get hung up on share accumulation. If the price goes up 1% or 100%, the return on your investment is the same no matter how many shares you have. So check out M1. Links in the description below. You can help support this channel by using the link to set up your account, and we both get free money. Trading is also free on the platform if you're into that sort of thing. Links for Webull and Robinhood are down below too, and they offer free stocks when you use my referral link. That's it. I'm Nick Toledo. This is Lemonade Stand. None of this is investment advice because that's what my lawyers told me to say. I'm just an idiot on the internet. They didn't tell me to say that part, but I can tell they were thinking it. I never know how to end these things. All right, peace out.
Move together 1 billion plus strong into a future of our own design, all connected through Apple!